Okay, so this video is going to focus on liquidity and stability ratios, and we're going to start by looking at liquidity. Now, these ratios, in particular the current ratio, assess the ability of a company to repay its short-term debts, and the concept we're really going to be focusing on is something called working capital. Working capital is the cash available to a business for day-to-day expenses. So, if there's too little working capital, what we're going to see is, the business might become, illiquid and be unable to settle short-term debts, which obviously is going to have ramifications for suppliers and customers alike. If there's too much working capital, then probably going to see, that a company might become ineffective because it might have too much capital tied up in day-to-day expenses, which could be used more profitably in other pursuits. So we're going to take a look at is called the current ratio. The current ratio is current assets over liabilities. Current assets are really short-term assets, or assets that are likely to change in value or be used in 12 months' time. So that's really the indicator that we use. If something's going to be used up within 12 months, then it's probably going to be a current asset. Examples might be, any cash at bank the company might have, or something like inventory as well, because we would assume that a company is going to sell its inventory within 12 months. Current liabilities then are going to be, short-term debts. So liabilities, any short-term debts, again, 12 months is the magic number here. And, these debts are going to be settled within the next 12 months. So maybe like a short-term loan, or maybe something like credit card debt, something like that. So what this ratio is going to do is it's going to take current assets divided by current liabilities, and really it's going to indicate the liquidity of a company by comparing short-term debt with cash in the business. The ratio really shows the amount of cash available for every dollar of short-term debts. How much cash that is available for every dollar of debt that the company has. If the ratio is actually less than 1, then the business doesn't have the cash needed to pay off their debts. So if the ratio is less than 1, the business will not be able to pay off their short-term debts, which obviously has, like we said, pretty serious ramifications for the business. Lose confidence of suppliers, but also, inhibit their ability to create a quality product in a timely manner for consumers. So we're going to take a look at an example of where we can use a liquidity ratio here. And we're going to calculate this liquidity ratio for Fremantle Shoes, the company Fremantle Shoes, in the year 2016. What's going to happen is we need to remember what our ratio is. We're going to take current assets over current liabilities. And we'd actually source this information from a balance sheet. So we can see here pretty clearly, we can indicate where our current assets and our current liabilities are. I'm going to have a look, and pretty clearly I can see that, already the current assets are greater than what current liabilities are. So I can tell this company is already liquid. But to get, an actual measure of the ratio itself, we're going to take this number, so 291,000, and we're going to divide that by 66,000. And then what we get at the end of the day is this ratio, which is 4.41. So this is a really high ratio in terms of liquidity for a company, what we can say in this manner is that, Fremantle Shoes actually has $4.41 of assets for every $1 of debt that they owe. So we can see that they're quite liquid, okay? They're in a pretty strong financial position. Now, whether or not this number is too high, right? We can go back to this assumption that, maybe this number might be too high. So maybe this company might be a little bit ineffective. In what they're spending their money on. Maybe got too much money tied up in their day-to-day expenses. And what we might be able to see is, maybe they want to actually transfer some of their current assets, maybe, their cash at bank or their inventory, maybe convert that into some non-current assets, so something that, lasts more than 12 months, or potentially even go into a little bit more debt and refinance in order to increase their production. We can compare this now in 2017 data, and still we can have a look at, again, our current assets and our current liabilities. I can tell already that the company is going to be liquid. I'm going to take my current assets at 193,000, divide that by 55,000. The number that I'm left with, or the ratio, our current ratio is 3.51. So what's happened is, our ratio has actually decreased from 2016 to 2017. The 4.41 ratio has decreased to 3.51. Now, one of the reasons for that is we might have seen either a decrease in our current assets or potentially an increase in our current liabilities. There are multiple different reasons why this has happened, but what's happened now is that Fremantle Press has $3.51 for every dollar of debt they owe. So there was a slight decrease in their liquidity, but they're still quite a liquid company, right? This is still quite a high figure. It's still significantly over the $1 mark, which is the category for a liquid company. And we can see here that, really the decrease that occurred in the current assets was due to a big decrease in cash at bank, which, more than halved from the 2016 figure. So that's liquidity. Really what we're measuring is, liquidity. We're measuring working capital. Can a business pay off short-term debt? And the answer is, if the ratio is greater than 1, then yes it can. It's a liquid company. We don't want it to be too much higher than 1, but that's a pretty good indication of a liquid company. We're going to take a slight change of track now and take a look at stability ratios. And what stability ratios really illustrate to us is this concept of gearing. Gearing. Now, gearing indicates how reliant on debt a business is for its operating funds. For operating funds. In other words, does a business need to go into, or has a business gone into a lot of debt in order to fund its operations? Now, this ratio really indicate whether a company has high or low gearing. A business that is highly geared, which generally, if a business is highly Highly geared, we usually say that this ratio is going to be above or greater than 0.5. This means that creditors have a greater share in the business than the owners. So if liabilities are in a sense too high a proportion of total equity, then creditors actually own a greater percentage of the business. High debt is really risky because debt repayments can be high when considering interest rates. And that's not really the situation we find ourselves now in the post-pandemic era, but it is an expense payment that businesses need to consider. Creditors may also take control of the business's assets if the business doesn't make repayments on time. And that's particularly important if you find yourself in this situation where your creditors effectively own more than 50% of your company. So the ratio we use to measure stability or gearing is the debt to equity ratio. The result is the number of cents of debt, both short and long-term debt, so total liabilities, for every dollar of owner's equity. In other words, how much of the owner's share of the business, so how much owner's equity is going towards debt repayments, This really gives an insight into the owner's true value of the business. If you're an owner and you're investing in a company, but then what we're seeing is, maybe the management of that company are going into higher amounts of debt, really your investment is funding the company's debt. And that's probably not going to give you too much of a return of investment, especially if you're in a investing in a startup company or a venture capitalist, something like that. So what we want to see is potentially a lowly geared business, so that the company does not have to go into too much debt to finance any of their expansions. In saying that, highly geared businesses are not necessarily always a bad thing. If you are a highly geared business, and your borrowings are actually maybe used for expansion. Maybe your borrowings, might be used to increase productive capacity. So you're increasing your productive capacity, then potentially, we might actually see, positive outcomes for your company, because that debt that you're going into is actually going to increase potential income down the line. So we'll take a look at an example here, and we'll look at the stability figures for Fremantle Press in our 2016 balance sheet. Now, remembering that our ratio is going to be total liabilities over owner's equity. Okay, now we can find these figures pretty simply. We need to actually do some addition for our total liabilities. So in any case, our total liabilities are going to be $866,000, and we're going to divide that by 2,840,000. Now I can see the difference between these two numbers, right? Obviously, owner's equity is greater than total liabilities, which by virtue of liabilities being, or equity being assets, liabilities, that's always going to be the case. But in this case, we can see that it's a good indication that our company is fairly lowly geared, because only 30% or 0.3 of our total equity is made up of debt. So we can put this into figures here. So 30 cents of debt per dollar of equity. So this company is fairly lowly geared at the moment. The company's total equity far outweighs the total liabilities that exist. The other thing we can take a look at is we can compare it with the 2017 data. So what we're going to do again, we're going to take a look at our total liabilities, and we're going to do a little bit of addition. So we're going to take 55,793. So that's going to be 848,000 divided by 3,230,000. And at the end of the day, that's going to give us a ratio of 0.26. So what's happened now is that our ratio has actually decreased from 0.3 to 0.26. So in 2017, there's actually 26 cents of debt per dollar of equity. So this ratio has improved for us because, in real terms, the company's paid off a little bit of its mortgage, and it's paid off, $10,000 of its loan as well. Owner's equity is also increased, which has meant that, in terms of when we're comparing equity to liabilities, that's actually improved favorably in terms of the owner's share as well. So ways to continue to improve this ratio are to keep paying off loans and to potentially increase equity by earning higher profits, or even by selling additional shares to shareholders for whatever reason. So that is our liquidity and stability ratios. Hopefully you've benefited from that video.